9 million homebuyers have been priced out of the market since the beginning of the year, and 3 million of those homebuyers are millennials. Now, surging mortgage rates have decreased affordability, housing inventory remains at all-time record lows, and investor activity has actually picked up. Hey, what's going on, everybody? Welcome back to the channel all about real estate. My name is Lewis, and in today's video, we're going to dig into an article from Business Insider that breaks down all of the information that I just mentioned there a second ago. Now, if you are new to the channel and you like all things finance, real estate, and investing, consider liking, subscribing, and sharing. And without further ado, let's get right to it. All right, so up on the screen, I have the article from Business Insider. I'll go ahead and link to it in the show notes below, but it is titled, "Millions of Homebuyers in America Have Been Priced Out Since the Start of the Year. Economists Say It's Likely to Get Worse." So, rising U.S. interest rates designed to slow down inflation have priced more than 9 million homebuyers in America out of the housing market. These mortgage rates have gone up dramatically over just the last few months since the start of the year. The average 30-year fixed mortgage rate was probably hovering somewhere around 3%. We are now hovering close to 5%, and we'll get into that here in just a moment. Nadia Evangelou, senior economist and head of forecasting at the National Association of Realtors, said that more than 3 million millennials had been priced out of buying a home since January. They said that the average monthly cost of purchasing due to the rise in interest rates is up nearly $270 per month. That's across the entire United States. Goes on to say that it's pretty demoralizing. The U.S. Fed has increased interest rates twice this year. I actually thought they only raised it once, but we'll continue. And then they're saying that there's 6 more rate hikes expected by the end of 2022. Now, of course, they are referring to the raise in the federal funds rate. As of this moment, it's sitting at about 0.25%. They raised it from 0 to 0.25, and they are expecting more rate hikes here in the future. Now, the Fed funds rate does not necessarily directly impact mortgage rates. However, there is a reasonable correlation. Generally speaking, when the Fed raises their federal funds rate, mortgage rates tend to track that, albeit with a lag. All right, the article goes on to say that in California, so this is the market that I operate in the Northern California area, the National Association of Realtors said that the monthly cost of paying for the median mortgage is more than $500 higher since January. And fewer than 30% of first-time homebuyers are able to purchase a home. Now, this is something that I've personally seen here in the California market. If you take a $500,000 loan, let's say, and you finance that loan at 3%, as opposed to financing it at 5%, the cost is about $500 more per month. So for buyers that are out there looking to purchase their first home, and let's say they were approved or pre-approved or qualified for a home purchase up to, let's say, $500,000. Well, now that rates have gone up, if they had debt to income restrictions or limitations previously, that rise in interest rates has decreased their purchasing power by about 20%. The article goes on to say that NAR, the National Association of Realtors, estimates that investors make up 22% of buyers across the United States, compared to 15% just a year ago. Cash offers account for 27% of all purchases. That's compared to 19% of purchases in early 2020. Conversely, the share of purchases by first-time homebuyers fell to 27%, and that is down from 33% just last year. The article goes on to give an example of a young couple that's trying to purchase a home in Massachusetts. They've been trying for the last 4 months. She says that the market has been pretty brutal, and the market, with the rise in interest rates, has actually decreased their purchasing power by about $100,000. This has actually limited the range of available homes in their preferred area. What's going on is that people are starting to make sacrifices on the location in which they purchase a home. They're going to tertiary markets or markets that are just outside of that geographic location that they want to be in. Maybe they're a 15, 20, or 30-minute drive outside of there. They're basically moving out in search for affordability. The young couple has actually showed up at open houses. They've been waiting to view these properties. They're waiting in lines. The line stretches around the corner of the house. And she felt that her and her partner had a pretty good shot of buying the home. They had a good salary, no debt, no kids. So they're in a good position to actually purchase this property. However, it's been pretty demoralizing. They went in feeling pretty hopeful. but that hope has diminished over. So this is really hard to read and to listen to. I am seeing that here in our local market as well. It's just so competitive and it's so challenging. But if you are a well-qualified buyer, if you're looking to purchase your first home, you cannot give up. You just got to go in with the expectation that it is going to be extremely competitive. One thing that I noticed about what they mentioned here in this article about sacrificing the area that they want to be in or reducing the amount of available homes is that's one thing I don't think you should sacrifice on. Certainly if there's budget restrictions, you may have to look in other areas, but in my personal opinion, it's better to find a home in a location that you like, maybe sacrifice on some of the finishes on that property. Like in other words, if the home maybe is a cosmetic fixer, but it's in an area that you absolutely love, let's say schools are a consideration if you have children or something like that, you can get into a property and then start working on cleaning that home up as you go. Maybe you put together a little renovation budget, you do a bathroom, you do some flooring and some paint, and you improve the property as you live in it, as opposed to finding that perfect property right out of the gate. Because for the most part, those properties that are super squeaky clean, they are turnkey, those are the ones that 80-90% of buyers are fighting over. So if you can find one that maybe needs a little bit of work, but it's in an area you like, you might actually have a better shot of getting that place. So across the board, in January, there was only 850,000 homes for sale. So we're under 1 million housing units. That is extremely low. Builders are not keeping up with the demand here, so we're still dealing with these housing shortages. There's no surprise there. Now, with the rising rate and the low levels of inventory, it means that availability of homes for middle-class buyers has fallen 60% since the beginning of the pandemic, with one affordable listing for every 125 households now, compared to one for every 45 households in 2019. The article goes on to give one more example that I thought was really interesting. It says here that Jonathan Tatum, he is a 27-year-old revenue data manager, finds he is routinely competing with up to 40 other buyers to purchase a home in Atlanta, Georgia. Very competitive market. Buyers' newfound willingness to pay the appraisal gap, which is the difference between the bank's valuation of the property and what you've agreed to purchase the home for, is starting to lock this gentleman out of the market. So buyers are getting really aggressive, not only with their price, but with their terms. So in many cases, some of these buyers are offering well over the asking price, sometimes 3, 5, 10% over the actual list price itself. Now, what happens here is that if you don't have homes that have sold recently that have actually closed at that price valuation, what sellers and listing agents are starting to look for is buyers that are willing to pay what we call an appraisal gap. So a very quick example would be if you write an offer for a property for, let's say, $600,000, but the appraisal comes in at $580,000, many buyers are saying they'll waive the appraisal contingency or they're willing to pay that $20,000 gap. In wrapping up this article here, it says that waiting is only going to make things worse. That is the sentiment echoed by Evangelou, with the National Association of Realtors forecasting sustained price rises throughout the year. However, they are expecting a slower rate of growth, somewhere between 4 and 6%. Evangelou goes on to say that if you are in a position to buy, if you feel financially secure, just go for it, because don't expect mortgage rates to come down anytime soon. All right, so this is the question I think that's on everybody's mind. A lot of people are thinking, are we in a bubble? Will this market crash? Will interest rates come down? And the reality is nobody has a crystal ball. We don't know for sure what's going to happen here in the future. Many forecasters are saying that rates are going to fall back down, but the challenge is timing the market is incredibly difficult to do. So, this is not financial advice, but for me personally, when I'm looking at this for myself and for my family, I'm asking myself a couple different questions. One, I'm asking, can I afford the monthly payment? 2, how much have I set aside for a down payment and closing costs? Could I comfortably deploy that capital into the marketplace and not feel like I have no financial runway? In other words, do I have an emergency fund or more cash in the bank to sustain in case things get really tough? And then the other thing I am looking at and questioning is the sustainability of my income. So am I in an industry that will continue to allow me to go to work and earn an income? income? And if the answer to that question is no, or I'm not sure, then maybe it's not the right time for me to purchase a home. The other thing I'm looking at is just a 10-year time horizon. A lot of times we're like, okay, where are the prices headed? And we're just looking in the short term, the next 1 to 3 years. We're like, oh, will prices go up or will they come down? That's probably the wrong question. The better question is where do I see myself in 10 years? Can I see myself living in this home for 10 years? Do I want to own this home for 10 years? Would it be a good rental property in 10 years? When you start working through some of those questions and answering those for yourself, it'll give you a better idea and paint a clearer picture of whether or not it might be a good time to purchase here in this market. All right, so that is going to do it for today's video. What are your thoughts? Do you think this market is going to sustain? Do you think we're in a bubble? Do you think prices will correct a little bit? Leave your comments below. We would love to hear from you. And if you haven't done so already, please consider liking, subscribing, and sharing this video, and we'll see you next time.